prices surge after further Ukraine attacks. US retail sales are set to bounce back. Japanese workers have secured bumper wage increases. The European Central Bank governors converge on a June rate cut. Britain exits recession, and inflation in New Zealand could beat the RBNZ's forecasts. That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview, ANZ Chief Economist for Greater China, Raymond Yeung, explains how a 2-tiered property system is emerging in China as the authorities there promote affordable housing over the private market. This could help take some pressure off that supply glut.
Overall policy on common prosperity, that the affordable housing will be the future model of China, and that will result in a regime shift in the China housing policy as well as the property market.
But first in 5 and 5 with ANZ. Oil prices rose overnight, with West Texas crude up 2% and Brent up 1.8% after further attacks by Ukraine on Russian refineries. The Aussie dollar was up over 0.4% at 66.34 US cents at 5 a.m. Sydney, Melbourne time, with the Kiwi trading up 0.3% at 61.67. In the United States, the S&P 500 was trading down about 0.1%, and the Nasdaq, it was down 0.5%, due to weakness in some of those big tech stocks and trepidation ahead of a large US Treasuries auction tonight. Markets are focused on US retail sales data later today, which is expected to rise 0.8% in February after a weather-related drop in January. Here's ANZ Head of FX Research, Marja Bin-Zaman.
The consumption outlook for the US really hinges on household income, which is then dependent on labor market dynamics. Both are broadly, you could argue, holding on so far. And as a result, I think looking ahead for February retail sales, we do expect a little bit of rebound post the unfavorable seasonal adjustment factors which weighed on headline and control figures in January.
Number 2. In Japan, annual wage negotiations have mostly closed with indications that workers have secured the largest pay rises in more than 3 decades. The average increase, set to be reported by the Ringo Trade Union Confederation, is expected to exceed 4 or 5%. That will drive Bank of Japan decision-making at its meeting next Monday and again next month, says Marja Bin.
What we are really looking out to see is that last year we had an increase of 3.6% as final result from Rengo negotiation. Anything higher from that would likely then possibly raise the odds of a BOJ hiking earlier. However, we do continue to maintain that we think that the BOJ will likely shift in April. Of course, that is because, they will also then have access to the Tenkan surveys, which tend to be a key input for policy decisions for the BOJ as well.
Number 3. The UK economy grew 0.2% in January from December, led by strength in services and construction. That offset weakness in industrial production. ANZ economist Bansi Madhavani says it looks like 2023's recession is over.
We are expecting economic activity to broadly start recovering this year and through next year as well. Of course, growth continues to be on softer side. Our expectation for it is to be around 0.3% this year. But the broader message that we took away from this morning's GDP release is that the recession is definitely behind the UK economy.
Number 4. Industrial production also fell in Europe. It was down 3.2% in January from December and 6.7% from a year ago as capital goods production slumped. This comes as bets increase that the ECB will cut rates from June, with a number of Governing Council members saying it is more likely than April. Here's Bansi again.
This morning we had the Bank of France Governor Villeroy speaking about June being more likely than April for a first move. But what I thought was particularly striking was Holzman, who is one of the most hawkish members on the council. Until a few months ago, Holzman was guiding that it is possible that the ECB may not cut rates at all through 2024. But we heard him say that rate cut is more likely in June than April.
Number 5. In New Zealand, selected price indices for February showed weaker than expected food prices, but stronger domestic airfares and higher overseas accommodation costs. ANZ economist Henry Russell says while ANZ is comfortable with its March quarter CPI forecast of 0.6% for the quarter, there is upside risk to the Reserve Bank's 0.4% forecast.
It's not just on the tradables side of the basket, it includes non-tradables too. But we think the Reserve Banks, given they're now more comfortable with the risk around the inflation outlook, they'll choose to look through any small starting point surprises provided that the broader disinflation story remains intact.
Henry Russell there. Now, in part 2 of our bonus deep dive interview on China's property market, ANZ Chief Economist for Greater China Raymond Yeung explains how the state is essentially setting up a two-tier property market, confirmed during last week's National People's Congress. And he talks about what that means for private property ownership there.
This is what we have observed recently in terms of how the government described the future housing policy. And they don't use the term two-tier. This is our labeling of based on our understanding of the policy, because the Minister of Housing and Urban Rural Development had talked about the future housing supply model in China would be in the form of affordable plus market. This is the official label of the housing policy, which means that majority of the population will be served by affordable housing model. Basically a public provision or maybe in the form of subsidized housing. Whereas for those who are willing or able to afford more and willing to have a different form of housing demand can be served by the private sector. So there will be virtually a public plus private market in the future. And we believe, given the current economic conditions and the government overall policy on common prosperity, then the affordable housing will be the future model of China. And that will result in a regime shift in the China housing policy as well as the property market. And with this change and paradigm shift, then we don't expect that the golden era of private residential housing will come back in the near future.
So what will this do to prices in the private market? And how does that link with the current stance of the authorities out of the NPC?
Yes, the Minister of Housing also reiterate this model of housing policy, the two-tier model, explicitly stating that the future housing model will be affordable plus market. But virtually, the government has been accelerating this type of policy. We know that locally, many local governments issued special local government bond and also in the form of local government financial vehicle, LGFV type of funding model to support affordable housing projects. And it could also be a one stone, two birds model. On one hand, that can also address some of the unsold property supply in the market, because now the government will be a buyer, or at least encourage the buying by providing subsidy to the local population. Secondly, and that's also relieve some of the cash flow tightness facing the property developers. So from both the housing policy perspective and also the financial stability perspective, it seems that this is a way the policymaker can address two problems, facing the economy.
Raymond Yeung there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, March the 14th. Catch you tomorrow with reaction to US retail sales. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.